Hey everybody, welcome back to another video. I know it's been a while, but today we have some serious fun stuff to talk about with IBonds. We are currently 2 weeks out from the IBond rate changing because of November 1st, the half-year change, and we have some pretty big changes in terms of rate and what you're going to be able to do. So we'll start with what we're currently sitting at. Of course, everybody knows highest it's ever been, 9.62%. As we can see here on the Treasury Direct site, you are going to need to purchase bonds by the 28th of October. That is the last Friday of October. But note that that 28th actually means the 27th because they generally make things wait until a day later to actually go through with the purchase. So if you're thinking about buying things, just note you have about 2 weeks from today, Thursday the 13th of October, to get those purchases in. So let's look at what the new rate's going to be. First of all, today the September inflation report came out, as we can see here from the Wall Street Journal, came in at 8.2%, which was honestly right about what they expected. They said they'd expected 8.1%, but a tenth of a percent higher, really right around there. Also what I, and really everybody else, thought it was going to be right at around 8%. No real surprises there. So what does that mean? That means we have our 6 months worth of inflation data to figure out what the new IBond rate is going to be. And going around the different predictions around the interwebs, all of the financial planners, all of the markets, all of the makers, what they think it's going to be, we've come down to right at around 6.5%. We can see here from Keel Financial Partners, just the first one that comes up. You can, Google and see what everybody else is thinking, but all the numbers come in right at about 6.5% when you do the math, which honestly is a bit surprising. I thought that the inflation was going to be slightly higher, reported inflation at least, and we get around 7%, but we're sitting at around 6.48. Let's round that up for simple talk to 6.5%. So what does that mean? With current rates sitting at 9.62%, if you are not maxed out for the year, you have 2 weeks again to get those in. If you buy any iBonds after November 1st, you're going to be getting the lower rate of 6.48%. Now, if you buy some bonds, say next week, Monday or Tuesday, you're not just going to get that 9.62% for 2 weeks. You're going to get it for 6 months. You get that rate for the first 6 months of holding that bond. Then it doesn't change over to the new rate, the rate that comes out until November, until 6 months later. So 6 months from October would be April. So you'd start getting that new rate in April. Just remember, while they change on the 1st of May and November, it doesn't change for you until 6 months after you've purchased the bonds. Going over that, if you aren't maxed out yet and you want to max out for the year, now is the time to do it. If you have the cash lying around, it's a good idea. I'm going to finish maxing out mine in the next week or so. If you're thinking about waiting till November, December, just note that if you do, you're going to be getting about 3% less, slightly over 3% less. Now actually going over and looking at what the rate is going to be for the full year, you take that 9.62 and average it with 6.48. If you are holding $10,000 in iBonds right now that you've bought in the last 6 months, that means you're going to be getting about 8% total return over the year. Remember that this 9.62, that's 6.48, you have to half that because you're only getting that for 6 months. You have to average those numbers together. You come out to 8%, which, not too bad. You're doing what the market does on average over the extremely long term with a lot more security there. This investment, it's a bond, it's a government bond, it's backed by the government's credit. Unless the government defaults or ceases to exist, you're going to get those interest payments. You're going to be able to cash these eventually. Now, with that 6.48%, should you be looking to buy, if you've maxed out now, you're looking to buy next year come January, or you're just not going to max out and you're going to finish buying in November and December, should you be looking at that? So 6.48%. Currently, with the way the markets are, this is much better than you're going to get from the wide market. If you ask me, if you ask a lot of people in the Discord, if you ask a lot of people in general, the markets really are they're in what you would call the shitter right now. Things are not looking good. I would expect inflation to stay relatively high. We're probably not going to go back over like 10, 11% in CPI. It's possible, but not likely. But we are going to see elevated inflation for the next few months, probably couple years. equities aren't doing well. They probably aren't going to do well until, something changes, until we go through a recession, until there's some kind of market correction, and we are just at the beginning. You could really, if people thinking that we're going to see a turnaround, we're going to see a Fed pivot or something like that, if you're listening to those kind of people, I would definitely branch out who I'm getting my information from. On the other front, in the terms of other bonds, currently we have, T-bills, notes, and bonds currently sitting anywhere from 3 to 4%. So, IBond's still doing much better. The 1-year IBond is doing, still, even with that new rate, is still doing 2% better than the T-bill. So, you're getting more bang for your buck as it is. Now, if you have maxed out and you want to look at things, that's where you might start looking at things like T-bills. If, let's say you've maxed out before, right now, today you put in your last bit of money to get that 10,000, but you still have some money left over, you could do something like a 3-6 month T-bill just to put your money away somewhere. You get it in 3 or 6 months, put it into a new set of I-bonds, maybe something like that. Especially if you don't have, a high yield savings account and you're sitting at one of those big banks with 0.01% and you're looking for a way to make a little bit more yield, but you've already maxed out on I-bonds. Short-term government debt is probably the way to go. Corporate debt's a little crazy right now with the way the bond market is falling. And again, equity's just rough to look at. And when it comes to government bonds, if you are going to look to, if you've gone past your maxing out on I-bonds and you want something, make sure that you're buying individual bonds actually through the Treasury and not buying bond ETFs, because those are going to continue to go down as bond yields go up, and bond yields are going to continue to go up until they stop raising interest rates, which isn't going to happen until they hit double digits most likely. So again, if you're maxed out on your I-bonds and you're looking for somewhere to stash a little bit more money, online savings account if you got it. If you can afford to, or you don't have an online savings account, you have a little bit of spare money lying around, short-term Treasury bills. I would say nothing more than a year probably at this point, because these are going to go up. You're likely going to see the 1, 2, and 3 year over 5% by January. I'd really stick between the 1 month and the 6 month T-bills, because you're going to be able to get your money right back out after a few months, be able to shove it right back into maybe, T-bills go up even further. Maybe they might even eclipse the IBond rate at 6.5%. If they do, at that point, you're going to want to be looking at T-bills instead of I-bonds, but we aren't at that point yet. So yeah, again, just remember you have about 2 weeks left to max out your I-bonds at the 9.62%. After that, you're going to be looking at about 6.48%. And next year, whether or not you want to continue in I-bonds, or you want to switch over to T-bills, or you want to be really crazy and go into equities, that's up to you. But again, my thesis has not changed. We are looking at extremely safe investments right now. Be risk averse unless you don't think you can be. Don't lose your money in crazy things. Same thing I've always said. As always, thanks for watching, and I will see you all next time.